Hey, in this video, I'm going to talk about how velocity banking can still outperform a 3% mortgage. Let's get into it. If you locked in a 3% mortgage, you probably feel like you hit the jackpot. And in one way, you did. It is a phenomenal rate we'll probably never see again. But here's the twist most homeowners never see. Even in 2026, velocity banking can use an 8% home equity line of credit to outperform that same 3% mortgage. And I get it. It sounds completely upside down. How can a higher rate loan possibly beat a lower rate one? Well, it comes down to one thing most people never learn: the difference between a long-term amortized note on a huge amount and a small balance, simple interest loan used strategically. Once you understand that math, the whole strategy flips. Hey, I'm Adam Carroll, founder of the Shred Method. I've spent years helping homeowners take control of their mortgages, paying them down or off in record time, and use strategies like this to start building real wealth in record time. So in this video, I'm going to walk you through why an 8% HELOC can still win, how velocity banking actually works in today's rate environment, and whether it makes sense for your particular situation this year. The misunderstanding everyone has about mortgage interest. Before we go any further, I want you to think about a scene from The Matrix. Neo sits across from Morpheus, and he's given two choices: take the blue pill and wake up tomorrow believing whatever he wants to believe, or take the red pill and see how the world actually works. And what I'm about to show you is that red pill moment. Because for most homeowners, the mortgage you're carrying, especially if it's 3%, it feels like a gift. But once you understand how interest is actually calculated on a mortgage, you'll start seeing the entire system differently. Let me give you a simple example to make this real. Imagine you have a $400,000 mortgage at 3.5%. On paper, it sounds incredibly cheap, but over 30 years, that loan can still cost you hundreds of thousands of dollars in interest. Why? Because that interest is amortized over a very long time, meaning the interest on it typically is front-loaded. You pay more on the front end instead of the back. So what it means is in the first 8 to 12 years of a standard 30-year mortgage, the majority of your payment is not reducing your loan. It's not building equity. It's not lowering your balance. It's paying interest over and over, month after month. You can literally write checks for years and barely move the needle on principal. That's the matrix most people are stuck in. Now, let me contrast that with something much smaller. Take a $10,000 or $15,000 HELOC at 8% interest, but only for 10 to 20 days. That sounds tiny in comparison, right? But the interest cost on that HELOC, even at double or even triple the rate, is dramatically less than the interest cost on a massive amortized loan stretched out over decades. This is the red pill moment. A low interest rate on a giant balance over a long period of time can cost far more than a high interest rate on a smaller balance over a shorter period of time. Most people compare interest rates. Velocity banking compares interest cost, and those two things are not the same. Your mortgage is amortized, meaning the bank grants you a 30-year payment schedule where they get paid all of the interest first. The HELOC is simple interest, meaning you only pay interest based on your average daily balance. If the balance drops tomorrow, your interest drops tomorrow. There's no front loading, no long timeline, no 30-year clock working against you. So when people ask, why would anyone use an 8% HELOC when they already have a 3% mortgage? The answer is actually simple. You're not comparing 8% to 3%. You're comparing simple interest on a short-term, shrinking balance to amortized interest on a huge balance that's stretched over decades. And once you understand that, velocity banking stops looking like a weird trick, and it starts looking like a smarter way to outmaneuver the amortization schedule banks never want you to think about. Why velocity banking still works in 2026. Now that you see the difference between amortized interest and simple interest on a HELOC, let's talk about why velocity banking still works this year, even when HELOC rates are sitting at 6.5% or 7% or 8%, and even when your mortgage rate may look unbeatable at 3%. The first thing I want to make really clear is this: Velocity banking is not about replacing your entire mortgage with a high-rate HELOC. That's the part people misunderstand. And honestly, in this environment, that would not make sense. I wouldn't do it, and I wouldn't suggest you do it either. These are often called a first lien HELOC. What we are doing instead is we're using a HELOC like a tool. It's not a replacement of the mortgage. It's a tool in conjunction with your mortgage. Think of it as a flexible line of credit whose only job is to help you go after the mortgage in chunks. We're talking $5,000, $10,000, $15,000, maybe $20,000. Small enough to manage, but big enough to make a difference. And here's where the strategy starts to flip the math in your favor. The moment you drop that chunk onto your mortgage, you instantly lower the principal. And because mortgages charge interest based on a long amortization schedule, every dollar of principal that you remove today saves you interest every single day moving forward. Now, once you've moved that 10 or 15 or 20 grand onto the mortgage, your income starts flowing into the HELOC, not your checking account, but your HELOC. And because the HELOC charges interest based on your daily balance, every dollar that comes in immediately lowers the cost of that borrowed chunk. So if your balance drops tomorrow, your interest drops tomorrow. It's that fast. And this is why comparing an 8% HELOC to a 3% mortgage doesn't tell the full story. That 3% mortgage, it sticks around for 30 years. And the bank wants you in that loan as long as humanly possible. The 8% HELOC in this strategy might live for a few months, maybe a year, maybe two, but you're not keeping that balance long enough for the rate to crush you. The timeline is completely different. So let me put this in a real example, because this is how I walk clients through it. Let's say that you've got a $350,000 balance left on a 3% mortgage. If you take a $20,000 second lien HELOC, so let's say it's at 7.5%, and you drop that chunk on the mortgage, and you do this a few times through the years, we can model the payoff dropping from 30 years down to somewhere between 6 and 9. That's assuming that your income and your expenses stay about the same. Even when we add in real-world variables like inflation or rising expenses or the HELOC rate bumping up a bit each year, it still works. In the worst case scenario, maybe your payoff timeline stretches from 6.5 years to 8 or 9 years. But 8 or 9 years is still dramatically better than 30. And this is the part I really want you to hear. Velocity banking isn't about chasing the lowest interest rate. It's about controlling the cost of your debt by controlling the balance and the time that balance exists. So when you use your cash flow intentionally, instead of letting it sit in a checking account earning virtually nothing, you turn the HELOC into a cash flow engine that works for you instead of against you. So even with a higher HELOC rates this year, the strategy holds because it was never about the rate in the first place. It was about the math behind how long the debt lives and what happens when you shrink that timeline on purpose. Why people actually choose velocity banking. Now, the math behind velocity banking is compelling, but the real reasons people choose this strategy have very little to do with the charts or the calculators. They're much more human than that. The first reason is simple. People want to deleverage. They want to reduce their monthly expenses and begin to take financial stress off the table. When you owe less, you can breathe easier. And for families who feel like they're constantly one emergency away from slipping backward, reducing that debt load changes everything. The second reason is about cost. And this is the real cost of debt. When you look at your mortgage statement, that little 3% number looks incredible. But when you see the truth in lending numbers and you realize that borrowing $500,000 might still cost you closer to $1 million over 30 years, you start asking different questions. You see, velocity banking gives you a way to shrink that cost dramatically by shrinking the timeline on which you're paying. Another reason people turn to this strategy, especially in 2026, is because we're in a weird investment cycle. Markets feel unpredictable. Inflation is jumping around. Rates keep moving, and many people are asking, where can I put my money that actually gives me certainty? Paying off a mortgage faster might not sound flashy or sexy, but it's one of the most guaranteed returns you can lock in. And then there's the security factor. When your mortgage starts dropping fast, it doesn't just feel good financially, it feels good emotionally. People tell me all the time, I just want to know we'll be able to afford braces and healthcare and college and retirement. And when you reduce the biggest liability in your life, you create room for everything else. One of my favorite insights comes from the book, What the Happiest Retirees Know. They studied retirees across the country and found one common trait among the happiest ones. That is, they had their homes paid off. Not because they were wealthy, but because they weren't living under the constant pressure of debt. And that ties into another reason many people choose this strategy. They're tired of being tired. They're tired of working jobs they don't love just to keep up with a 30-year mortgage. They want to build margin. They want to take control of their time again. And when your debt falls, your options grow. That's what I call the wealth flywheel, where your money starts working for you instead of the other way around. Velocity banking itself isn't just about interest rates or financial tricks. This, at the heart of the strategy, is about financial freedom. It's about giving families control over their future rather than letting a 30-year schedule control them. So here's the bottom line. Velocity banking isn't about beating the bank at some interest rate game. It's not about finding the cheapest rate or swapping one loan for another. It is about understanding the true cost of your debt and then using your cash flow intentionally to reduce that cost as fast as possible. And when you do, you create more discretionary income, more monthly freedom, more margin. So if all you ever look at is the number printed on your mortgage balance, 3%, 3.5%, 4%, 5%, whatever it may be, it's going to feel like you've already won. But when you finally see how much interest the bank collects over 30 years and just how slow your principal actually drops, that rate starts to look a whole lot less appealing. And this is where velocity banking changes the conversation. It takes you out of the 30-year timeline the bank wants you to stay in, and it lets you use an 8% HELOC strategically, temporarily, and with discipline to destroy principal early when it matters most. When you do that, you're not comparing 8% to 3% anymore. You're comparing a higher rate on a short-lived balance to a lower rate on a massive balance stretch across 3 decades. That's why the math works. That's why even in 2026, with higher HELOC rates and all the uncertainty we're living in, this strategy, it still makes sense. Listen, I think your home should be your greatest asset building tool, not your biggest liability. And velocity banking, the shred method, how we incorporate both, is simply a structured, intentional way to make that happen by controlling your balance and your timeline instead of letting amortization control you. And when you shift from thinking about interest rates to thinking about interest costs, everything clicks. And once that clicks, you'll never look at a 30-year mortgage the same way again. Now, if you're listening to this and you're thinking, I want to see what this looks like for my numbers, which you should be, by the way, then I want you to head over to theshredmethod.com. There you'll find a savings calculator where you can plug in your numbers and it will show you in real time what your results could be. We will show you as a group, step by step, how fast your money could move when it's working for you and not against you. I'm Adam Carroll. Thank you for watching. If you like this, drop a like and subscribe if you found value. We put these videos out at least once a week, and I want you to send this to a friend if it makes sense, if someone else in your community needs this information just as much as you might. And I'll see you in the next video.